Hey everyone, Mark Rusin here, back for another video. On my Twitter account, I recently ran a poll on top video ideas that you would like to see in my next videos here on YouTube. The number one rated answer, or the most voted answer, was the reveal of my dividend portfolio. And if you haven't checked out that video, that was the exact one I did last week. I will put that link in the description down below, as well as on the top of the screen here as well, so definitely give that a view. But the second most voted on answer was 5 REITs that I like for 2022. So that's exactly what we're going to discuss here today. If you have followed me on social media for a while now, or even watched my YouTube videos, you understand that I am big on dividend investing. But underneath that, I am big on REIT investing, which is a form of dividend income and another form of passive income. It's a way for me to gain exposure to the real estate industry. And in fact, 15% of my dividend portfolio is made up of REITs. For those of you unfamiliar with REITs, I've created a resource that is an easy to read, and in fact it's called A Guide to Understanding REITs. So definitely check that out. I'll put the link to my resource down in the description down below, but I'll detail exactly what REITs are, why they are a smart investment to be added to your portfolio, how they've performed and outperform the S&P 500, and how they differ between private real estate and investing in REITs when looking for real estate exposure. Before we get started, as you know, I put out all of this content for free. If you could do me a huge favor and smash that like button down below and give us a big thumbs up, that would be huge for the algorithm and the growth of this channel moving forward. Also, if you love dividends and passive income, consider subscribing so you are notified anytime we drop a new video. With that being said, let's jump in. As always, everything discussed in this video is for informational and educational purposes only, as I am not a financial advisor, so please perform your due diligence before investing in any stock or ETF mentioned in these videos. If you are looking for a great brokerage to open up and get some free money while doing it, maybe you're just starting your investing journey, then head down to my link down below and check out M1 Finance. For everyone that opens a new account, it could be a regular taxable account or a IRA brokerage account, you will get $50 free just for opening and funding that account within 2 weeks. Also, if you're interested in crypto, I also have a link down below to BlockFi, where if you open a new account, they will give you some free Bitcoin to get started. Okay, first let me lay the foundation of this video and just give you a high-level understanding of what REITs are. REITs stand for Real Estate Investment Trusts. They are corporations, and they must comply with a set of different requirements to be able to qualify as a REIT. And if you are a REIT, you are shielded from corporate income taxes. One of those requirements is you must return 90% of your taxable income back to shareholders in the form of dividends. This is why you see REITs have much higher yields more often than not than regular stocks that are taxed at the corporate level, because these guys are forced to return money to shareholders based on being a REIT and not being taxed at the corporate level. There are many other things that make a REIT unique, so definitely check out my resource to learn more and understand why REITs are a great investment to be added to your portfolio. With that being said, let's take a look at 5 top REITs for 2022 and beyond. The first REIT we will discuss today is probably one of the most recognizable REITs in the public markets today, and a gold standard for the real estate investment trust sector. And that is none other than Realty Income, stock ticker O. If any of you have watched any of my prior videos, you know that I love Realty Income, and there's a number of reasons to love them. They have great management team, a strong portfolio, and most of all, they pay a monthly dividend. They've actually trademarked themselves the monthly dividend paying company. Although the company paying a monthly dividend is pretty awesome, they also have a great track record. In fact, since going public in 1994, the company has only had 1 year where they saw negative growth. In 2020, we saw the start of the global pandemic. Many retailers were forced to shut down their doors, and it affected landlords in a big way. In fact, REITs were hammered for much of the year in 2020, but only 3 REITs came out on top with positive earnings growth, and Realty Income was one of those 3. Part of that reason is due to the fact that the company has a very strong portfolio of properties. These aren't just properties that you see in a broken down city. These are A-rated properties. They're properties that tenants want to be at and are on waiting list to be at. In fact, the tenants that Realty Income works with isn't just any mom or pop shop. Over 50% of the rent earned for Realty Income, it comes from investment grade tenants. Here's a look at the company's top 20 tenants, some of the names of which you might know. You will see 7-Eleven, Walgreens, Dollar General, FedEx, and Dollar Tree make up the top 5. Other notable tenants within the top 20 include Walmart, Home Depot, CVS, and Kroger, to name a few. Looking at the chart here, you can see that over the past year, Realty Income has returned 18.7%, and that is even including the sell-off we're seeing in the markets to start the year here in 2022. The company currently pays a dividend of $2.96, which equates to a dividend yield of 4.4%. The company has a 4.3% compounded annual growth rate for the dividend since going public in 1994, and they have increased that dividend 112 times and counting. In terms of analyst ratings, the stock is currently rated a buy with a 3.8 rating on a 1 to 5 scale, with 5 being a strong buy and 1 being a strong sell. The average analyst price target for Realty Income is $78, with a price target high being $92. Realty Income is about as consistent as they come. Like I mentioned from the start, they have a strong management team. They have a strong portfolio and a strong tenant base, all making up a consistent dividend-paying stock that you can rely on in your dividend portfolio, making it the first REIT for 2022 and beyond. The second REIT we will discuss today is Simon Property Group, stock ticker SPG. Simon Property Group is the largest mall owner in the United States. In fact, if you've ever been to a mall, odds are that it's more likely than not that it was a Simon Property Group facility. The company doesn't just own your everyday mall, they own the best and the highest quality malls in the US today. In fact, they have a strong A-rated portfolio. There's an accounting firm that puts out a regional mall classification each and every year so you can distinguish one mall from the other. It goes from an A+ rated mall all the way down to a D rated mall, and it's all based on the retail price per square foot. So if these malls are able to do high quality businesses and they get high quality tenants in there, more likely than not, their retail per square foot is going to be much higher, making it an A rated mall. When it comes to Realty Income, leading up to the pandemic, they had a very strong A-rated portfolio. Now here we are 2 years later since the pandemic had started, and they are still an A-rated mall. So this is a very high quality company with a great management team led by David Simon himself, and also a very strong portfolio of malls. As you can see looking at the chart here, the company has had a very strong year the past 12 months. In fact, including the sell-off that we've seen at the start of the year, from a market-wide sell-off I should say, shares of SPG are still up an incredible 55% over the past 12 months. Some of you may be thinking to yourself, well, malls are dead. But in fact, the malls that are going out of business and shutting their doors are in fact these C-rated or D-rated malls that aren't getting much traffic. And that's what I started with my opening statement there, is SPG, or Simon Property Group, has some of the best, most visited malls in the US. There's a few reasons to be excited about shares of SPG moving forward, even after the year that we've seen them have these past 12 months. There's a lot of tailwinds in the sector, and we're not even going to include the dividend, which I will touch on here in a minute. Much of the leases that Simon Property Group enters into with their tenants are tied to inflation. As we have seen these past few months, inflation is running at an all-time high, with massive boosts in inflation, or growth in inflation, that's really touching the pocketbook of every consumer out there, but it's also going to touch the pocketbook of tenants. Obviously, the pandemic hit the company hard, which made occupancy numbers tick down a little bit, but over the past few quarters, we're starting to see some momentum and more retailers get more comfortable returning to the malls. Okay, now let's get back to the dividend. Currently, the company pays a dividend of $6.60, which equates to a dividend yield of roughly 4.5%. Dating back a few months, the company actually increased the dividend an astonishing 10%. Anytime you get a 10% raise, it's always enjoyable as a dividend investor. The dividend is covered well by strong operating cash flows, as well as an A-rated balance sheet. In terms of ratings, analysts rate shares of SPG a buy with a 3.95 rating and an average price target of $176. 8 analysts currently rate the stock a strong buy at current levels. The third REIT to consider for your dividend portfolio in 2022 and beyond is VICI Properties, stock ticker VICI. VICI Properties is not your typical net lease REITs like we have seen with Realty Income, who has tenants like Home Depots and Walmarts and 7-Elevens. VICI Properties is a specialty REIT, and they own properties like casinos. If you're driving down the strip in Las Vegas, most likely you're going to see a VICI property. VICI Properties is another REIT that I actually mentioned in my top 10 dividends for 2022. I love this REIT and I love the upside, especially that we're seeing with the travel. Many people, there's such an uptick in demand for travel as people are wanting to be done with this pandemic and being stuck in their homes, that they just want to get out and travel. And VICI Properties is one of those companies that is going to generate strong, or at least their tenants are going to generate strong income here in the near future once travel comes roaring back as we expect. One of the things that makes VICI Properties stand out from the rest is that during the eye of the pandemic, the company still maintained 100% rent collection in a time when REITs were seeing their rent collections cut in half or even worse than that. VICI Properties maintained 100% rent collections, telling you that their tenant base is quite strong, even considering we were in a global pandemic. Again, during this time in 2020, when the pandemic was hit and it was really unknown what this thing was, the company increased their dividend 11%. There's not too many companies out there, especially REITs. In fact, many REITs were cutting or halting their dividend altogether, but really VICI Properties comes back and increases their dividend 11%. That's a pretty strong flex if you ask me. Another thing that makes VICI Properties unique is the fact that they force their tenants to keep their properties looking pristine and unique, so that it's always continuing to have traffic inflowing to these properties, because they want to have the best looking real estate properties on the strip or wherever their casino properties are around the US. In terms of the dividend, VICI Properties currently pays a dividend that yields 5.3%, so you get a very strong yield and you also have an opportunity for some strong growth. In terms of the analysts, they currently rate shares of VICI Properties a 4.77, which is enough for a strong buy rating. The average price target for the company is $36 with a price target high of $51. There's 18 analysts that currently cover the stock, and 15 of them rate shares a strong buy. So definitely take a look at VICI Properties for your dividend portfolio in 2022. The fourth REIT to consider for your portfolio in 2022 is Medical Properties Trust, stock ticker MPW. Medical Properties Trust is yet another unique type of REIT. So we've covered a retail REIT with Realty Income, we have a mall REIT with Simon Property Group, we have a casino REIT or gaming and entertainment REIT with VICI Properties, and now we're going to Medical Properties Trust, which owns a wide range of hospitals. In fact, the company has 444 properties with 52 different operators, over 46,000 beds in 32 states in 9 countries. The unique thing about hospitals is it's a in-demand property. Hospitals are needed, and they're also a high barrier entry point. So this makes Medical Properties Trust very unique. In fact, Medical Properties Trust is the second largest non-government related owner of hospitals in the world. We could discuss turnover when it comes to retail tenants. Retail is going to see a lot more turnover when something's in or something's out. They're going to see companies shut their doors and terminate their leases more often than not. But when it comes to hospitals, that's not the case. Hospitals are much more in demand, and in fact, less than 1% of hospitals close their doors each and every year. The company doesn't just have operations here in the US. Although 60% of the revenues of MPW come from the US, they're looking to grow and expand their international presence, which is another growth catalyst for this REIT moving forward. One thing to look out for, though, when it comes to Medical Properties Trust is its high debt. The company has a BB rated debt portfolio, and company outlook is stable, but it's something to definitely keep an eye on. Besides the debt, another thing to pay close attention to is the operators. But the great thing about Medical Properties Trust is they don't have an operator that accounts for more than 3% of the total base rent that they bring in each and every year. In terms of the dividend, the company currently has a yield of 4.89% and has grown that dividend an average of 4.24% per year over the past 5 years. And management has increased the dividend for now 8 consecutive years. In terms of the analysts, 14 analysts currently rate shares of MPW a buy with a 4.28 rating and an average price target of $25. The fifth and final REIT we will discuss today is Public Storage, stock ticker PSA. If you've ever been driving down the highway and seen a self-storage unit, a bright orange self-storage unit, most likely you've come across a Public Storage self-storage property. Self-storage has blown up in the past few years as more and more, especially Americans, hoard more things, but they're also looking for more space to gain inside their homes, but they don't want to separate from some of these things. So what do? Instead of stuffing their garage, or maybe they already stuffed out their garage, is they go and rent a self-storage unit. And the company has blown up in the past year. In fact, shares of Public Storage have grown nearly 60% in the past 12 months alone. This is tremendous growth for a real estate investment trust. The company has been in operation for nearly 50 years now. They also own 2,678 properties within 39 states, making it one of the largest REITs in the public market today. Although the sector has been quite strong over the past 12 months, I expect more tailwinds moving forward, especially as interest rates are looking to rise here in the near future, and they may rise quite quick. What does this do? This makes owning a home much more expensive. If you want to move and get a bigger home to have more space, you will need to pay more in terms of interest. So instead, you may get a lot of homeowners that say, hey, let's just stay put and let's move a lot of this stuff out so that we can get some more space. Where are they going to move that? They're going to move these things to a self-storage unit, which provides tailwinds for a company like Public Storage. Like we have discussed about many of the other REITs we've talked about today, Public Storage is backed by an A-rated balance sheet. The company has strong cash flows, which would further tell you that you have a secure dividend from this company moving forward. In fact, we should see a continued rise in the dividend moving forward. Speaking of the dividend, the company currently pays a dividend of $8 per share, which equates to a dividend yield of 2.26%. In terms of the analysts, they currently rate shares of Public Storage a buy with a 3.82 rating and an average price target of $376, with a high price target of $433. So there you have it. 5 top REITs to consider for your dividend portfolio in 2022. A lot of these REITs have a lot of things in common. They have strong management teams, strong portfolios, and a strong tenant base for which they work with. I hope you enjoyed the video, and if you're looking for other videos like this, definitely subscribe. Obviously this video was about REITs, but if you're more curious about non-REITs, then check out my 10 dividends for 2022, or if you're more interested in ETFs, you can check out this video where I discuss my top ETFs for 2022. I hope you enjoyed today's video, and if you haven't done so, please definitely give us a thumbs up, as that's huge for the growth of this channel moving forward, and definitely take advantage of the M1 Finance offer where you can get $50 free just for signing up and opening a new account. With that being said, we will see you in the next video. Take care.